All right, ladies, let's get started. We are going to talk about public Indian housing file review today. And this has kind of been one of those little mystery things where we've been reviewing the files, but we never had that prefer rule. We don't really know what exactly we're doing. Are we using Section 8 rule? Are we using tax credit rules? What are we doing? So today we're going to hopefully clear up all of those questions that I know a bunch of you guys have been having. So this is the list of what we here at Prefer have. And this is why it's so important that we have to do this right, because on the contrary of what we thought, we actually have more properties with PIH funding source than we thought. We have 1,900 units for properties with the PIH funding source. We have a total of 32 properties and 6 of our clients, and I actually believe there are more, but right now 6 of our clients have the properties with the PIH funding source property that they have with us. Let's start with the basic of what is Section 8, okay? So Section 8 is started with the Housing Act of 1937, established by President Roosevelt, used to be called the Wage-Stigo Act. There are actually 411 sections, and the 8 sessions of that Housing Act establishes the lower income housing assistance. The main purpose is to provide financial assistance for the provision of the decent, safe, and sanitary for family of low income and create the Public Housing Authority. A quick summary of Section 8. There are 2 types of Section 8, tenant-based versus the project-based. And for tenant-based, it's really only one type, which is the housing choice voucher. For project-based, it's broken down to 2 additional types. We have the project-based voucher, the PBV, and then we have the project-based rental assistance, which majority of the people think when they said Section 8, this is what they think about. It said PBSA. The PBSA or PBRA are interchangeable, and they are pretty much the same thing. Now, the entity overseeing these programs, the housing choice vouchers and the public project-based vouchers, those are overseen by the Public Indian Housing Department of HUD, while the project-based rental assistance or project-based Section 8, that is overseen by the Office of Multifamily Housing Program. All right, just to kind of give you guys an overview of what exactly and how each of those 3 programs work. So we have here for the Housing Choice Voucher, the Office of Public and Indian Housing. They issue a annual contract, annual contribution contract to the Public Housing Authority, who in turn issue vouchers to the tenant. So these people get on the waiting list for the vouchers. Once the voucher is issued, the tenant look for apartment by themselves. It can be market, it can be LIHTC properties, it can be publicly owned or privately owned. They look for their own housing and they execute the lease with the property. From there, the property, before they accept the lease and move the person in, they establish a separate contract with the Public Housing Authority called the RFTA, Request for Tenancy Approval. Once that is approved, then the housing assistance payment contract, or the HAP-C, is established between that particular property with the Public Housing Authority. So for the housing choice voucher, they actually have tiny little HAP contract for every single voucher holder that the PSA needs to maintain. Now, on the other hand, for the project-based voucher starts again the same with the Office of Public and Indian Housing. From there, they issue a voucher annual contribution contract, or the ACC, to the Public Housing Authority, who then have the HAP payment contract directly with the property. So this is where the difference starts. So instead of having tiny little HAP contract between each voucher, they have one big voucher for each property. That property then execute and lease each of the unit with project-based voucher with little tenant. Now the tenant has obligation directly with the public housing authority. So this means even though the contract for the half payment is between the property and the housing authority, the property themselves actually doesn't do anything with the family with the exception of the lease. All of the obligation as far as the income and the income certification is done directly with the housing authority. All right, last type, which is what we are most familiar with, which is the project-based rental assistant. For this one, the HAP contract is actually executed directly between the Office of Public, that should actually say Office of the Multifamily Housing, not PIH, I apologize. So the Office of Multifamily Housing execute the HAP contract directly with the property, and from there, the property execute a lease directly with the tenant. On the other side of the hand, the Office of Multifamily Housing execute a separate contract called the annual contribution contract with a performance-based contract administrator who is the one monitor compliance for the property, which means they're the one monitoring the HAP payment, monitoring that all the regulation are followed. In general, yes, they are all still quote unquote Section 8. Here I have a few differences that is highlighted between the program. So for housing choice voucher, as we mentioned, is monitored by the PIH. It's operated by the housing authority. Most common when you guys hear Section 8 in your tax credit world, this is what people think about. They use the 5A. The voucher can be transferred outside of the jurisdiction. What that means is if you live in Miami and you're going through Miami-Dade Housing Authority and you have a voucher and you want to, let's say, move to Orlando, which is under a different housing authority, you can put in a request and move that voucher outside of the Miami-Dade Housing Authority to be used at a different county. For transmission to receive the HAP payment, they use PIC or PIC, and the contract rent can be adjusted throughout the year multiple times as long as the housing authority receives 60-day notice, and they have to use the public housing authority utility allowance. For the PBV, monitored by the same people, it can be operated by either the PHA, which means the property is owned by the PHA, or by the owner agent if the property is owned by an independent developers or investors. It actually has the same funding source as the HCV, except for RAD program, which is something entirely different that we're not going to talk about today. Also similar to HCV, it uses the 5A, also uses the PIC for data transmission. Contract rent can only be adjusted once a year. After residing in the project-based voucher unit for 1 full year, tenant actually gets to jump to the top of the waiting list for the housing choice voucher, and then use that housing choice voucher and use the voucher for any property and transfer it out of jurisdiction, just like the regular housing choice voucher. So majority of the time to get into the project-based voucher is easier and faster to get a housing choice voucher. So a lot of the time, the housing authority recommends people to go and move into the project-based voucher first in order for them to jump to the top of the waiting list. Now, for what we're all familiar with, the PBRA, monitored by the multifamily housing, it's operated solely by the owners or the agent for owner, which is the management company, overseen by the contract administrator or the performance-based contract administrator. The differences between the two, the contract administrator is actually HUD themselves. Performance-based contract administrator is a private entity who, in easiest way to explain that is they bid for the contract through an RFP, and then once they win, they become the contract administrator for HUD. Unlike the SCV and PBV, they use the 5.9. Instead of PIC, they use tracks. And similar to project-based voucher, the contract rent is adjusted annually, and they use rent schedule for the utility allowance. So the main income determination, the public Indian housing follow multiple different things. Main thing is they follow the 24 CFR Part 5. They have their own manual, which is not very good, and I'm going to show you guys that here in a little bit. Each PHA should establish an ACOP. However, it is not required. If they do establish an ACOP, it has to, at the minimum, meet the 24 CFR Part 5, but majority of the ACOP are more restrictive. Now, on the Section 8, on the PBRA side, they just follow the 4350.3 with any housing notice that may have come out after the 4350.3 most recent revision. So that's when the housing notice or the Federal Register kind of overtake that. All right, so now you guys are probably going, okay, well, what is public housing? We're talking about the project-based voucher, the housing choice voucher. So what exactly is public housing in comparison to those three things? Public housing is HUD version of conventional housing. So that's really, really weird, right? Because it's technically not Section 8. It's their own thing. It's conventional housing that is developed, owned, and operated by a public housing authority with a fund that derive from government sources. They use the low income limit, but they are still dealing with pre and post 1981 issue, whether or not they can admit people above or above 50% or not up to 80%, and they still pay income-based rent, but there are just no rental assistance. So they're not dealing with HAP when it comes to public housing. Before I move on to the occupancy guideline, does anybody have any question? Or is there anything that I went a little too fast that you guys want me to go over real quick? That was the basic as far as what the public housing is. All right, let's move on then. Let's talk about the occupancy guidelines. So we're going to talk about the income and asset determination. As I mentioned, PIH has a manual. This is a link. You guys will get a copy of the slides. And also I will make sure to share the recording as well. This is the link to the guidebook for PIH. It's applied to both a housing choice voucher and public, PBV project-based voucher. As you can see, it is not completed. You can see on the bottom left of that screenshot, there's a bunch of little coming soons because they are pretty much revamping the entire guidebook. They did have a guidebook that were published back in 2014. So anything that it has not been covered by this new webpage are still going through that 2014 version of the guidebook, which is really just the prettier version of the 24 CFR Part 5. Let's talk really quickly about method of verification. A few things on here is going to blow your mind, okay? They have 6 levels of methods of verification that is as published by the 24 CFR Part 5. They go by level 6 down to level 1. Level 6 is the most restrictive. Level 1 is what we really don't want to use unless we absolutely have to. So we all got to know what EIV is, and then we go down to the UIV. UIV is an upfront income verification. This is like the work number or verify.com, or in many states they have like a database where the public housing authority have access to, which verify public assistance like TANF and food stamp, so they can access the database directly. And then we go to level 4, which is, with the exception of EIV and UIV, what we would normally get and want to see when we're doing the file review. These are third-party generated documents, so stubs, bank statement, benefit letter, something from the letterhead, showing the income or asset information that we're looking for. Level 3 is the written third-party verification form. So this is that traditional third-party verification, which on the tax credit world, this is what you guys want, where you don't want the tenant to bring you anything. You want the verification form completed with authorization. You send it to the third party, they fill it out, they send it back, we show proof of delivery. That's the level 3. That is actually less desirable per the PIH office in comparison to things like pay stub and bank statement. Then we have the oral party verification, which we're not going to talk about because we know we don't like that. And then the last resort, which is the tenant declaration. Size statement is not required to be notarized, and it also needs to be documented why option 2 to 6 is not available. So as you can see here, they want option 2 before you're using option 1. So if you are going to the last resort, we want to still try to get the third party oral, but we're not ever going to use the third party oral by itself without a tenant declaration. That's kind of as our backup because we don't like the oral verification. Income inclusion and exclusion, there's a very slight differences between the 4350 versus the PIH guideline. I'm not going to go over everything in details. I have a link here. There's two different ways that you can get the income inclusion and exclusion. It is either in the manual in Chapter 5, Exhibit 1, or in the 5-9 instruction booklets. A quick general rule for income inclusion and exclusion in regard to the individual residing within the household. So the main thing is everything is very similar to the tax credit world and the Section 8 world that we're familiar with. What we are not familiar with is the earned income disallowance right here. So let's talk really quickly about what EID is. So EID is when somebody has an income and we're simply just not counting it just because they said so. There's no other reason about it. It's literally just because the housing authority said, you know what, we're not going to count those income because I said so. Let's go into that in a little bit more detail. The EID will be addressed in the ACOP for that particular housing authority. The VP or the SPM over the client with properties that have public housing needs to look through the ACOP, and they're going to note that in the property tab. If that particular property has a earned income disallowance where you would not be counting that income, it still needs to be verified, and we'll talk about how to deal with that here toward the end. But what this is the housing authority will exclude the full amount of the increase for the initial 12 months out of the 24 months based on the date that in which individuals start receiving the increase. Or they will exclude at least 50% for the remaining 12 months. They can exclude more if the ACOP state that they will, and they're going to begin the exclusion on the first of the month qualifying after the qualifying change, so after the effective date. So for the reason that they do the EID is so that it's kind of encouraging people to go out and get a job to better themselves. People worry about, if I get a job, my income is going to increase, and if my income increase, my rent is going to increase. So when PHA elect to do the EID for the property, that helps the tenant to go out and better themselves and earn that income, and giving them that 24 months period where they are not going to be experiencing a drastic rent increase and trying to get their lives in order without affecting their income when what they're trying to do to better their lives actually increasing their income. Does anybody have any questions about that one before we move on to other type of income? Nope? Okay. All right, so temporary or sporadic income. So if the family expects to receive additional income from the source in the upcoming year, even if the payments are made on an irregular basis, the anticipated income should be estimated and counted as income. So our rule on the FFP side is when we are spotting irregular income from bank statement, because keep in mind, we want bank statement. That's third-party verification method that we prefer for the PAH property. We're going to analyze the amount received from the past 3 months, unless we have a notarized statement, which is like the notarized recurring contribution statement. If they're saying we can't get a notarized statement, or they're getting income from 5 different sources, then we are going to use the most 3 months. Michelle just said she lost audio. Does anybody else still hear me?
I can.
I can.
I can hear you.
Okay. Okay, Michelle said it's back now. Thank you, ladies. So HUD came out and it's very, very clear that they said gift for holidays and birthday are excluded. So when they do that clarification that Carrie taught in our recent staff meeting, when they indicate a certain thing is, Christmas gift or birthday gift, we are going to exclude those income when analyzing any irregular sporadic income. Okay, lump sum payments. So not applying to the SSI, SSA, retroactive, but other periodic payment like unemployment or welfare assistance, those are included as income. But only if they receive, after the initial date of participation in the public housing program. Student financial assistance, same rule as Section 8 and tax credit. Any amount received on above the tuition is counted as income unless they're over the age of 23 with dependent children. All form of student financial assistance are excluded if they're residing with the parents or guardian in a public housing. So here's another thing for the FFP people. Unlike the multifamily housing department who oversees the Section 8, the project-based Section 8, the public and Indian housing allows and actually encourage in certain circumstances for you guys to use the year-to-date calculation. So let's look at the quick, a few methods that they talk about. The year-to-date, they are actually very specific on when and how the year-to-date calculation is used. Year-to-date can only be used if they were hired prior to January 1st, and if the most recent pay stub is dated after March 1st. So I'm going to interpret that as the end date of the most recent pay stub to be conservative. This is recommended when there is pay fluctuation throughout the year. I'm gonna go over the how to do it and what income to use on the 5-9 here in a little bit, so don't worry about that just yet. Then we have the stub average. The requirement per the PIH is the minimum of 2 and no more than 6. The standard preferred rule is what we're going to be using, which is the 6 stub, unless it's the new hired. We still want a minimum of 4 stub, and we still want the VOE. So we're kind of going with the home-ish rule thing here, and I'll kind of go over how that works in a little bit. Then we have the recurring. Recurring is it's like when we have the employment verification, we don't have sufficient number of stubs. So we're going to use that recurring income calculation based on the VOE only. Now, if they are a new hire, that's okay. We can go ahead and move on. If they are not a new hire, we want to make sure we get 4 to 6 pay stub to back up because the stub is considered a higher level of income verification for the PIH properties. And then we have irregular, which we talked about earlier. A minimum of 1 month is required for PIH to annualize and no more than 3 months. We're going conservative for our rule. We're going to use 3 months data to analyze. And this we will also apply to child support calculation for irregular payments. So if somebody said that they are not getting child support like what they're currently being ordered, the preferred rule is the minimum of 6 and no more than 12. The PIH rule is using 3 most recent full months to analyze the child support income. If it changes, that's when they report the change, and then we do an interim recertification. Let's talk about the employment income and the method. So we're looking at the good, better, or best method. The good method is things like employer generated income verification letter. We have an offer letter, which, as you know, with preferred rule, we don't accept offer letter unless the start date has not commenced yet. Then we have better, which is things like the printout pay history. We actually would prefer the full stub, like a whole stub itself. But the better would be we get the printout pay history as long as it show all the deductions and show detail. Oops, I apologize. The best is the things like the UIV, upfront income verification, the work number, verify.com, the pay stub, and then if they have not started their employment, the offer letter would be the best method to use that with. Unlike the tax credit and the Section 8 that we have come to love and familiar us with, PIS preferred third-party generated document like pay stubs and things on the letterhead or printout or offer letter over traditional third-party verification. Because we're awesome, we are going to be more conservative than pretty much anybody else out there in the industry. Our rule for employment verification kind of borderline what we're currently using for home fund. We want 6 steps at the minimum, 4 if this is a new hire. We also want to obtain verification of employment on top of those steps. And then we're going to compute 3 calculations showing stub, recurring, and year-to-date if only the dates allow per what we talked about in the previous slide. The income you're going to be using on HUD 59 is going to be the stub calculation. From the VOE, you're going to be applying things like anticipated changes and annual bonuses to stub calculations or tips. If it's not reflecting on the stub, make sure that if they work in the service industry, you guys are using tip affidavit. And then if the annual income from recurring wage a year to date differ really drastically from stub, we need to obtain clarification as to why. There are going to be circumstances where using recurring, using the VOE or using the year to date represent the household income better than using the stub. As long as the file is really well documented, we can go ahead and use those. Neither of those is going to result in a finding at the time of an audit. Don't go straight to the tax credit method of using the highest number, because keep in mind, whatever number we use is going to determine their rent. So we want what actually represent what they're making, not the most conservative where what is the possibly highest income amount that you're going to be making. Just to give you guys a quick why behind our reason. The reason we don't want to use stub alone is because it doesn't reflect anticipated earnings and changes. So things like anticipated pay increase or the annual bonus that are a sure thing. Now, if they come back on the VOE and said they anticipate a pay increase and it's going to be on January 1st, but they don't know the amount, clarify that they don't know, and if they really don't know, do not include. Do not use the 3% pay increase method that the tax credit world uses. If they say they are getting an annual bonus, but they can't anticipate amount, you can use previous year. Ask the site team, can you get, like, they're going to get a Christmas bonus in December 2020, but they don't know the amount. If they don't know, well, how much did they get for 2019? We can do that for the PAH properties. And another thing is, because majority of our property are layered with other programs like LIHTC, VOE is really needed because we want to properly document household eligibility to satisfy others' requirement. And also, we want to make sure that we exceed all the ACOP requirement variation between one public housing authority to the next housing authority. Any questions on employment income verifications and calculation method? Any concerns? Okay. Let's talk really quickly about streamline income determination. So I kind of went over this very quickly a few weeks ago during the staff meeting, but I want to go over this with you guys again really quickly. So the Public Housing Authority can elect to apply a streamlined income determination if the family is receiving fixed income. So let's look at what fixed income are as far as the PH definition go. They're talking about periodic payments at reasonably predictable levels from one or more of the following sources. As we know, they're talking about SSI or SSDI. They're talking about pension from federal, state, or local, or a private pension like the Boeing company or Microsoft, I believe, have pensions. They're talking about annuity, retirement benefit, or any other sources that is subject to adjustment by a COLA that is verifiable. So that's the main thing here, is it needs to be verifiable COLA. The streamlined income determination, it adjusts based on either one or two of these methods. If 90% or more of the total income from the household, when I said total, we're talking unadjusted. So before you're taking things out like childcare and medical expenses, if 90% or more of their income is fixed income, we can use COLA on the fixed income, and we're gonna leave all the other non-fixed income alone. We're not gonna make adjustment on that at all. So for example, they get Social Security and they work. Social Security make up to 90% or more of the total household income. We're going to apply the COLA increase to the Social Security, and we're going to use the previous year employment income on the current year 5/8 and 5/9, actually, because it's applied to the regular Section 8 as well. Now, if the fixed income represent less than 90%, we're going to apply COLA. We don't have to verify, we're just going to apply COLA, but the non-fixed income like work is going to have to be third-party verified. Now, this is why we say the COLA have to be verified. You can print it out on the website, like for example, if they're receiving a pension and the pension company publish what the COLA increase percentage might be, we can print it out and use that. If they cannot get a verification of that COLA or an increased percentage, we will need to do a full third-party verification of that particular income. Let's talk really quickly about an asset. So if the family asset is less or equal to $5,000, they only need to do third-party verification at move-in or at an annual recertification. Between the year, they can use an asset affidavit, and our asset affidavit that is being used for the tax credit property is perfectly okay to use with a PIH or the regular project-based Section 8 properties as well. Use the same rule. Married people can use the same form. Unmarried people need to fill out separate one, just like the tax credit world. Asset verification, if they select to not use the streamline rule and only verifying at move-in and every 3 years, they are verifying asset every single year annually. Don't issue corrections. Majority of the clients, for example, I believe WLM is one of them, elect to verify asset every single year. That is perfectly fine. And unless the ACOP state otherwise, we're still going to go with a more conservative rule of the 6 months for checking, 6 months average for checking, and the current balance for the saving account. And then, since bank statement is considered level 4, while traditional third-party verification is considered level 3, we're always going to ask for 6-month bank statement for checking account and most recent statement for saving account. If they are sending in things like direct verification from Bank of America or from any other bank, we technically can't accept it unless they give us a reason why bank statement is not available. Okay, let's talk. Well, we're not going to talk about this because actually they're exactly the same as the regular project-based Section 8 that we're familiar with. They still get the same elderly disabled allowance deduction. Dependent allowance is $480 per dependent. Disability assistant, medical assistant, childcare expenses, all of this use the exact same method that the project-based Section 8 is using. Next that I want to talk about is the validity of the document. So PIH has zero information on what they want to see as far as how old the document can be when you're using those documents for the purpose of certifying a household eligibility. This is actually set by each housing authority, and it is addressed in the ACOP. Based on the industry standard of what people are doing across the country, we have established the following rules. All of the document must have a date stamp of when it was received. All the document must be dated within 60 days of when it was received. For ranges of document, for example, if they have multiple steps or we're looking at bank statement, use the most recent date to determine validity of that document. Last, the document even cannot be more than 120 days old as of the effective date of the certification. So for example, if they're starting the annual recertification 120 days prior to effective date, because they should, they give us a document and we date stamp it. The document is a month old when we receive it. But since it's a month old and we start the certifications 120 days prior to the effective date, that make that document more than 120 days old as of the effective date of the certification. So we can't use it, okay? Let's talk quickly about the ACOP variation. So any variation from the preferred rule is going to be noted in the next gens under the property requirement tab. So things like, for example, Williamstown under WLM, they accept 3 months rather than 6 months. We're going to accept that. When steps are used, they require 8 rather than 6. So we're going to go with whatever the ACOP says. If they elect to use the streamlined income verification, meaning just applying COLA to the fixed income method, it needs to be noted here as well. If somebody is sending in a file that are using the streamlined income verification method and there's nothing noted in the property tab, reach out to the SPM or the VP for that client and confirm before you issue a correction, because we want to make sure that maybe they just haven't told us they're doing it rather than just issuing a corrections on something that they are doing correctly. Now I'm going to move on to talk about the ever-loving form, the 50058. Before I start talking about the actual form itself and how to review this form, does anybody have any questions about the general rules and what we talk about so far? Nothing? I guess I'm doing amazing. All right, let's keep going. So when we talk about the 5.8, there are multiple pages to the 5.8. There are actually 15 pages. I don't know why they have to make the form so darn long, but that's what they did. We're going to go with it. When we talk about the form, we're not going to say page 1, page 2, page 3. We're actually going to refer to this as section. So as you can see here, this is page 1. We have section 1 and we have section 2. Okay, so let's take a quick look on section 1. The first thing I want you guys to take a look at is column 1C. This indicates the program. And what program they indicated determine what section they're actually filling out on the 5.8. So indicate here, look on the second column. I probably should have flipped this. I apologize. That would have made more sense. But if they indicate that this is a public housing, they're going to be filling out section 10 of the form. If they indicate that this is the project-based certificate or a project-based voucher, they're filling out section 11. If they indicate this is a tenant-based voucher, they're filling out 12. Mod rehab is 13 and home ownership voucher is 15. 13 and 15 we're not going to talk about today. We're only going to talk about 10, 11, and 12. Now, section 1 through 9 are always completed regardless of the program type. Section 2, we're going to take a look at the type of section, and the number right here represent the type of transaction that they are doing as well as the effective date. Then within the section 2, note if this is a corrected 5A. Similar to a 5-9, if they realize at a later time that they were something that were calculated incorrectly, or maybe they found unreported income, they can correct a previously submitted certification that has already gone through the PIC. If this indicates a yes, that means that the 5A that they sent in, so think about when you got reviewing the file. For tax credit, you ask for the IC tick. For HUD and RD, you ask for the most recent certification. So the most recent 5A or the most recent 5.9, the most recent 3560. If this indicate a yes, that means the most recent that they are sending you should be the same certification that were previously submitted to PIC. So the one that they're correcting. The reason we want to see that is because when they're correcting a cert, they are only going to be verifying the changes, whatever that change may be, a new income, a new asset. Everything else is going to remain the same. So we're going to want to see that previous 5.8 or 5.9 or 3560 to compare those information so everything else can remain the same. The next thing is the date admission to the program, the 2S. This is not necessarily the move-in date. This is the day that they got the voucher or they got admitted and reached the top of the waiting list and they were approved for the voucher. Now let's talk about section 3. Now the most awesome thing I love about 5.8 compared to the 5.9 is they have cheat sheet on the bottom of every page to tell you what is going on and what their codes are. So I'm not going to go over too much of what each of the code mean because it's pretty self-explanatory. One thing I do want to note is all the youth under 18 with the relationship code of Y, that is regardless of the disability status. So if you have a 15-year-old child who is verified to be disabled, you're still going to use the code Y rather than a different code for that person. A quick note on the Live at 8. This came out in July. I wasn't sure if everybody is aware, but Live at 8 actually can reside in the unit with a child, or they can be married and their spouse can actually reside in the same household, even though they're not performing any Live-in aid duties at all. This came out as a part of Section 811, frequently asked questions, but it's actually applied to all of HUD in general. And as far as whether or not on the tax credit world this is allowed, I'm going to let Carrie and Mitzi answer that once. If you guys have specific questions on the tax credit side of thing on how to handle Live-in aid, reach out to Carrie, or Carrie, if you want to jump in, you can. But as far as the HUD world, not the RD, the HUD world, if we have a Live-in aid person and they have a child or they have a spouse, they can't live in the same household. And I saw Carrie unmuted, so.
I did. It's funny you bring that up. I'll include this in the training on Tuesday because it's the same for the tax credit world. For years, we said, no, they cannot have kids in the unit. But it is permitted now based on that guidance.
Awesome, thank you. Okay, let's talk really quickly about disability status and what classify a person as disabled. I show a verification of disability status form during a staff meeting a few weeks ago, just reminding you guys that if you do see this in the file, you need to make sure that they are using the correct version of the verification form. For any public Indian housing property, it's going to say that on the very top. If they're using a wrong version, it is not going to verify the status of the person correctly. What considered disabled for one program may not be the same for the other, so make sure they're using that as well. Now, similar to HUD and RD, if they receive SSI or SSDI, they are considered disabled, so we don't have to do a third-party verification. But if you have a person who is not receiving SSI or SSDI, and they claim that they're disabled and they're trying to do medical expenses, you need to make sure that they are verifying those disability status, and they can do so using the form. Okay, section 4. In general, the family income may not exceed 50% of the median income for the county. If it is a pre-1981, remember we're still dealing with the pre and post universe, they can actually go up to 80%. Now, by law, the PHA must provide 75% of voucher to those at the extremely low or the 30%. Now, therefore, if the family income exceeds 50%, the column 4F needs to be selected. What that column, what this particular box mean, that it indicates HUD has approved for the PHA to pretty much say, I'm not gonna care about that 75% rule. So if the PHA does not have that approval, that means a person exceeding 50% cannot actually move in, and they have to make sure that that 75% requirement is actually met. The 5-9 world, the project-based Section 8 actually have similar rule. The income targeting rule is slightly different. I can't remember off the top of my head, but I believe it's 50%, or I apologize, it's 40%. 40% of admitted people needs to be at 30% or lower for the multifamily housing. For the PIS, it's actually 75%. Let's look at section 5, pretty easy one, just a general information on the unit. Make sure you note the apartment number and the number of unit to make sure these match in the rest of the information in the file. Section 6 and 7 is just the asset and the income information. All the money amount entered on the 5A are going to be routed using the 5-4 method, and they have to include both the included and excluded income. So what that means is, as you know, food stamp is an excluded income. We don't care about food stamp. We don't verify that when we're dealing with the regular Section 8, the RD, or the tax credit world. If they said they have food stamp, we go, oh, okay, thank you, we don't care about that. For the 5A world, we do need to verify all the excluded income, and they need to be listed in the section 7 right here under 7E. Now, the field that listed as calculation, this is where you see things like if the verification of employment showed that they got $3,000 per month, you might see that they do 3,000 multiplied by 12 over here in these boxes, or sorry, there will be this box because that's income, or if they are calculating a interest rate for the saving account, they can use this box right here for calculation. They're not required to use them. This does not get transmitted to HUD for any reason. So majority of the time, the 6C and the 7Cs are going to remain blank. If there are an entry, you do need to make sure that it makes sense though. Similar to the previous page, we got the cheat sheets on the bottom, which I thought that's really, really awesome. All right, section 8. We're talking about deduction or allowances. There are two different types of deductions. We have mandatory and we have permissible. Okay, so the mandatory deductions or mandatory allowances, these are set by HUD and there are no cap. Use the same rule as a 4350 for those things. So things like medical expenses, disability apparatus, the child care expenses is the same rule as HUD. There's no cap. If they have $100,000 worth of child care expenses, because they're stupid and they don't find anything cheaper, we put $100,000 $100,000 childcare expenses in the file. There's no cap. Permissible, and I'll go over what the permissible is. Permissible is a type of deduction that is set by the Public Housing Authority per whatever the ACOP states. There is a rule that it must be capped at no more than $90,000 per household, regardless of the number of family members that the household have. So the bottom part in blue is where you'll see all the mandatory. The top part is where you see all the permissible. Same thing as a mandatory. If they have any permissible deductions, you need to make sure that those are verified and is in the file, and it is also allowed per the ACOP. That will be noted in the next gen. Okay, Section I, this is the final calculation of the tenant's obligation, or the TTP, before addressing the utility allowance. So for PIS, the TTP is the highest of these 5 items right here. We got 10% of the gross, 30% of adjusted, welfare minimum, or enhanced voucher minimum. The most recent TTP right here should match the most recent 5.8 that they sent to you for review. So this is how you can make sure that the most recent 5.8 that they sent is really the most recent 5.8. A lot of the time the site think that, oh, when we send the most recent, they send you the previous year AR, when in reality they've done 3 interims since then, and they didn't send you the most recent interim that they're done. So this is how you can kind of use, in addition to the EIV, because as you know, you can see the most recent certs on the EIV, but this is another way that you can check to make sure you have the most recent info. Okay, now let's talk about specific sections in regard to the program types. So section 10 and beyond, and how we calculate the final rent information. So the first one, public housing. A quick reminder, this is that conventional housing version of HUD, okay? We have the flat rent. Flat rent is set by the unit size and building. And what people living in the public housing gets is when they go in, when they go in and they do a income verification every year, PHA is gonna go, do you want income based or do you want a flat rent? Do you want to just pay this amount that I'm giving you, or do you want us to determine your rent based on your income? And the tenant gets to pick each year. They can go back and forth in between the year. They can make the selection once a year at an annual recertification. That means at an interim, if they selected income based and at an interim their rent goes up, they can go back and go, never mind, I want flat rent now. The changing between the flat rent and the income base can only happen at an annual. And technically for PAS, it's called re-examination, not recertification, by the way. So by having the option, this is another way that public housing is encouraging residents from working, because if they're working and they're bettering their lives, in turn their rent actually increases. So this is kind of a way of allowing the tenant to continue making their life better without increasing the obligation as far as their monthly bill go. The next portion I want to talk about is the ceiling rent. Sometimes it's also called a maximum rent. This provides a cap on the amount of rent a family can be charged. So this cap the TTP. So you have now the flat rent, which is like, this is the rent that they set for the property, right? And I'm going back really quickly. That is no less than 80% of fair market rent. They have the ceiling rent. The ceiling rent is at the fair market rent, unless HUD approve a waiver. So if they decide to set a ceiling rent, that's entirely separate from flat rent. So that means that if the tenant select to go with the income-based version of their rent calculation, their TTP does not go above what the ceiling rent is. I hope that makes sense. Now, the prorated rent, we're barely ever going to see that. We're only going to deal with prorated rent similar to project-based Section 8, which is when there is a mixed family dealing with citizenship stuff. And the way to calculate that is exactly the same as project-based Section 8. All right, next one is Section 11. Section 11 is the project-based voucher. The thing that you're going to be watching out for are going to be the 11K, M, S, and T. So the K is the contract rent. So unlike the public housing, you're going to have contract rent very similar to project-based Section 8 or the regular HUD property. So this is the rent that needs to make sure it matches the lease, it matches your RIS. Then you have the utility allowance, make sure that that also matches the RIS. Then we have the tenant rent. This is the amount the tenant actually pay the property every single month. And then we have the half amount. If the rent is negative, that means they get the utility allowance, which is something that we don't deal with, but just so you know that there can be a negative amount. Section 12, we're talking about the housing choice voucher, the SCV. Now, the one that we're going to watch out for are going to be the 12A, C, J, M, U, and V. I know I just went over that really fast. Okay, so 12A, this one right here is the number of bedroom on the voucher. That can be different than the actual number of the bedroom for the unit. Remember back in section 5, it tells you the actual unit, the actual number of the bedroom. We see this a lot with Huff property, if that kind of ring a bell for any of you guys, where they have a voucher for a 3-bedroom, and then they selected a 2-bedroom on a property, and we go, okay, what UA they're selecting. So this is kind of where you're seeing that on the voucher side of things that you're not seeing on the Huff when you're reviewing the Huff files. In general rule for HUD, the number of bedroom, this is what they were approved for by the voucher department. And then number 12C, the family is considered hard to house. If this is a yes, 12C, this is right here. If this one is a yes, they're only considered hard to house if they have at least 3 minor or a disabled family member. So if you see 12C and it say a yes, and you don't have any disabled person, and they don't have at least 3 little kids, or technically not little kids, so teenager would count as well, then this line is wrong and it should reflect no. 12J is a payment standard. So that kind of go back a little bit to the 12A. So if they issue a voucher for a 3-bedroom, they pick a 2-bedroom, they're going to issue payment for a 2-bedroom, not a 3-bedroom. Vice versa, if they're approved for voucher for a 3-bedroom, but they're selecting a 4-bedroom, they're only going to be issuing payment as high as a 3-bedroom. Then utility allowance, help amount, and tenant rentals are pretty self-explanatory. All right. In summary, you will only see 5A pages 1 through 7. So remember, pages 1 through 7 is section 1 through 9, which is filled out for everybody regardless of what particular program they are under. Then it will skip to page 8 for section 10, page 9 for section 11, and then page 10 for section 12. If you're seeing pages 1 through 7 and then you go to a page 10, do not issue a correction for missing page 8 and page 9, because that doesn't exist if they're a housing choice voucher household. Okay, there are additional pages, as I mentioned before, for things like mod rehab or home ownership. Those are like on page 11, 12, all the way to 15. We're not going to talk about that. Those are not the type of program that we review, so we're not going to look at those things. All right. This slide should actually have been removed. I apologize, but that is all we have. And look at that. I promise you guys will be done in an hour. I have 3 minutes to spare. Does anybody have any questions, or is there anything that you guys want me to go back and go through? Hopefully I didn't go through this too fast. No?
If somebody has a live-in aid and their live-in aid has like a child or a spouse, what do they get? Do they get coded under anything on the 50058 to document their
That is a great question. That's a great question. Thank you. They're coded on the 5A and the 59 as a live-in aid, regardless if they're 2 years old or 20 years old. Anybody else? That's a good question. Thank you, Sam.
Paige, is there any guidelines on occupancy standards, or would that follow through with the ACOP?
ACOP.
Okay.
Anybody else's? Now, a lot of the things that we talk about today are new. So continue to reviewing your file as is. Give time for your SPM to go to the client and go over these changes. Once the changes are made, they're going to be noting. You guys need to be noting from talking to you, Megan, Connie, and Tiffany, and Carrie, if they are okay with going with the changes that we are recommending as far as the preferred rule goes, until we see it one way or the other under the property requirement tab in next gen, reviewing the file like an as is with what you've been doing. If there are anything that you're like, you know what, this is totally against the minimum program requirement, feel free to reach out to me and we can look over it on a case-by-case basis and see if that is something we need to go to the client immediately and make adjustments, or if that is something that is acceptable, we can just proceeding. All right, well, ladies, thank you so much. I appreciate your time.
Thanks for doing this, Paige. I really appreciate it.
Yes, thank you, Paige.
Thank you. It was
Thank
much
you.
needed.
Thank you.
Thank you.
Have a wonderful evening.
Thank you.